Hello and welcome to the SwissPE TV studios in Geneva. I'm Sam Meredith and I'm joined today to discuss investment opportunities by Yann Corbaz, founder of SwissPE. Welcome, Yann.
Good afternoon.
So first of all, could you tell us a little about the situation for private equities market in Switzerland?
1.2 billion Swiss francs is the estimated total amount of investments in private equity funds raised on the Swiss markets last year. Around 150 Swiss venture companies were financed with 300 million Swiss francs. According to the European Private Equity and Venture Capital Association, Swiss private equity companies exited around 50 entities, with a total amount divested at a cost of 450 million Swiss francs. Trade sales accounted for 45% of the number of companies exited, and IPO accounted for 10%. So, but this is not to be compared with the performance of the Swiss M&A markets. The number of transactions announced for the two first quarters in 2015 reached a volume of 20 billion Swiss francs as a result of the mega deals.
Okay, so can you talk us through some of the interesting, perhaps, investment opportunities in Switzerland?
I would answer in the real economy. The small and medium-sized enterprise SME are the engine of the Swiss economy. SME produce or will produce revenue. High-tech startups and companies based around the Geneva Lakes are very promising. In the nanotechnology, biomedical, flying robots, robotics, and startups based in APFL, Swiss Institute of Technology in Lausanne, will become the leader of vehicle lighting device, for example, or genetic diagnostic, immunohistochemistry, products against counterfeiting, etc. So they are a very good opportunity for private equity investments. Private equity investors not only provide additional capital, they also give share business market experience, and they work together with the managements to make the business successful with pretty high revenue.
Right, yeah. So what are some of the most appropriate investment vehicles?
The Swiss legislation, for example, the Collective Investment Scheme Act, SISA, introduced the Swiss Limited Liability Partnerships, SLLP, for collective investments in risk capital. They are subject to FINMA approval. This is probably the most appropriate investment vehicle for Swiss entities. It consists of a general partner and a number of limited partners. General Partner is a stock company incorporated in Switzerland. It can delegate investments decisions or other activities to third parties. The shareholders can at the same time be shareholder and control other stocks corporations acting as general partners in the others SLLP. And the limited partners must be qualified investors, such as pension plans, corporates, family office, family trusts, and of course high net worth individuals. The SLLP is tax transparent and not subject to a corporate income tax. In addition, there are two others main legal structures. Investment company with Barial Capital, SICAV. It's an open-ended investment vehicle. It can issue shares at net asset values. And we have also investment company with fixed capital, SICAV. It can increase or decrease the share capital based on the shareholder resolution. But both SICAV and SICAF are subject to FINMA approval, of course, but they are not often used for private equity due to their open-ended structures, like contractual funds.
And lastly for today, what are some of the exit options?
The main exit for investments are trade sales or an initial public offering, IPO. It depends on the situation and the context. The advantage of trade sales are that the transactions costs are pretty low. The selling shareholders receive the sale price immediately, so they save any amounts to be deposited in escrow or earn out. And the realization of the highest price is available at that point of time, in time. And the confidentiality of the transaction, as it is not public, and a sale to a strategic buyer can increase the company's options to develop its business. So it's a win-win situation. Disadvantage of the trade sales could be the selling shareholders may forego later increase in value, we say step-ups. It exists a possible dispute also on liability for a breach or representation and warranties. And the investor have to keep of the proceeds in escrow as a security. Then IPO. This is one of the most popular exit strategy because when the proper market conditions are available, this method is likely to enable the investors to realize the highest return on its investments. The advantage of an IPO are the selling shares can wait for a higher price. The company and the funds can increase their visibility and credibility in the markets. The employee can also be incentivized by the company with the shares or options. With listed shares, the company receive a second currency for acquisitions. And you have also additional financing could be also be obtained in the capital markets. So the disadvantage of an IPO is the lockup provisions bind the core shareholders for a period of between, I would say, 6 to 18 months. No quick cash realization, cash out is possible. The transaction costs are pretty high. You have also the public attentions. The listing process use a lot of resource for the company and the fund. And the company becomes subject to various compliance rules and ongoing disclosure obligations. So maybe to conclude, if I may conclude now, what private equity can offer is an active ownership structures, renew focus, international networks to support expansions, financial assistance in add-on acquisition and strategic business expertise to make the business more successful. Private equity investor will exit from the business in the end of the investment cycle. So their interests are to make the company more profitable and to increase their values. This is the reason why this ownership model is so powerful in contributing to economic growth and value creation.
Okay, Yann, thank you very much.
Thank you.
And thank you for watching. Be sure to click back to Dukascopy TV for more updates and exclusive interviews. We'll see you next time.